There are three big mistakes I see people make when they're doing Roth conversions or failing to do a Roth conversion I'm going to cover in today's video. Now, first I want to break down what is a Roth conversion. This is where you can take a traditional IRA or traditional 401k and convert it over to Roth. The difference being when money comes out of a Roth account at retirement, it is not taxable. You're pulling out $100K a year from your Roth IRA when you're 65, no taxes, you pull it out. If you keep a traditional IRA and you start pulling out $100,000 a year, when you hit 65 or whenever you start pulling this in retirement, you pay taxes on that. Let's say you're in a 25% federal and 5% state tax bracket. You didn't pull out $100,000. You really only got 70 because you had to send $25,000 to the IRS and $5,000 to the state. So the Roth account is far superior in retirement. You'd rather have a Roth account when you start pulling money out than a traditional because you get taxed. Remember, traditional IRAs and traditional 401ks are tax deferred. You're not paying tax as you're building it up. Once you start pulling money out at 59.5 or later, you got to pay tax on it. The Roth, no tax on the way out. So that's why people like to get over to a Roth conversion. Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement. But I'm going to dig into the mistakes here and let's talk about the first. All right, the first is people failing to do a Roth conversion because they don't want to pay tax now. I think that's a big mistake. Trust me, I'm a tax lawyer. I don't love paying taxes, but the deal on a Roth conversion is way better in the long term for you. If you look ahead 10 or 20 years, you're going to be so glad you did a Roth conversion. And I know it's painful now. You're going to get a 1099-R from your IRA or 401k custodian that's going to go on your tax return. You're going to have to pay taxes on the value that you converted. But let's break down an example here and I'm going to illustrate why this is valuable to you. Let's assume you have $100,000 right now in a traditional IRA or traditional 401k and you're deciding, should I convert that to Roth or not? Now, if you convert it to Roth, you're going to pay tax on that $100,000. It goes into your taxable income. You're going to get a 1099. Now, let's assume you're in a 25% federal bracket, 5% state bracket. So you have a total 30% tax. That means you're going to have to pay $30,000 in tax now to convert that $100,000. Now, I know that sucks now, but trust me, it is short-term pain for long-term gain. So let's say that you're 40 years old right now and you're going to look to pull this money out when you hit age 65. That's a 25-year window of this $100,000 growing. Now, let's assume you're getting a 10% annual rate of return on your money. And let's assume you're not even putting more money into your IRA or 401k, just this same $100,000. Well, that $100,000, if you invested at a 10% annual rate of return over 25 years, will be $1.1 million. Now, at age 65, that $1.1 million, if you did the Roth conversion, is coming out entirely tax-free to you. You are paying zero tax on that. You are going to realize $1.1 million. Now, it cost you $30,000 25 years ago, and I understand that. That was painful. But remember, that short-term pain is giving you long-term gain of tax-free wealth coming out this whole $1.1 million. If you didn't convert, and here would be the mistake, what you'll be paying in tax is 30%. Let's assume the same tax brackets now. You're paying 30% tax on $1.1 million. You're not getting $1.1 million. You're getting $770,000 and you're paying $330,000 in taxes. That's not good. We would rather be pulling out $1.1 million rather than $770,000. So that's the difference. Pay $30K in tax now or pay $330K in taxes later as you're pulling the money out in retirement. All right. Now, the second mistake people make when doing a Roth conversion is they pay the taxes from the retirement account. Don't do that. I know most custodians have a form where you can elect to pay the taxes and send it to the IRS from the account. If you do that, you are paying tax and penalty on that amount that's going to the IRS. For example, let's say you have a $100,000 IRA you're converting to a Roth IRA, and you're going to have $30,000 in taxes to the state and federal government. And you say, hey, IRA custodian, send that $30,000 to the IRS and maybe to my state. What's going to happen is they're going to process that as an early distribution, 10% penalty penalty on that 30 grand. There's 3,000 of penalty. You also have to take it into your taxable income. Let's say again, you're in that 30% tax bracket. There's another $9,000 in taxes. So now we've got $12,000 going in taxes and penalties because you decided to send 30 over to the IRS to pay the tax on the conversion. Don't do that. Pay the taxes outside the retirement account. That's a much better deal. Even if you don't have the money, get on a payment plan with the IRS or your state to pay it over time. Never pay the taxes out of the IRA or 401k when you're doing a Roth conversion. Now, the third mistake people make when doing a Roth conversion is they fail to think about what your financial situation, your estate looks like at age 65. When you hit age 65, you start thinking of things differently. You start thinking about who's going to inherit my retirement account now. Do I need to take RMD on my retirement account? What does my tax situation look like? I've actually built wealth, maybe have some investment income. I'm drawing money out of the retirement account. That matters when you're at 65. So let's talk about a few of those points here. First, if you've converted to Roth, there's no RMD. In a traditional IRA or traditional 401k, you have to start pulling money out of that retirement account at age 63. You don't have to do that in a Roth IRA or Roth 401k. No RMDs are required. You can preserve the tax-free nature of that account and continue to build it even in your 60s, 70s, 80s, 90s, however long you are able to live. And you get to pass on that Roth account to your spouse or to your kids, and they get to keep that as a Roth account as well. There's some special rules when your kids inherit it. They might have a 10-year window, but that still stays as Roth dollars, growing more and more tax-free wealth for them. If on the other hand, you had a traditional account, you're going to be whittling away at it. You have to start pulling the money out. The IRS wants to start taxing you on that money. So you don't have to worry about in the Roth account. That's a huge benefit and perk. And why a lot of retirees actually start converting their traditional dollars to Roth in their 60s is because the time they hit their 70s, they don't want to have to be pulling any money out of their retirement account. They want to keep growing it and preserving that tax-free bucket of wealth. And they'll pull on it as they need it. Obviously, we're going to start drawing on this at some point, and maybe some of you don't. Your kids get it passed on, or your spouse, and they get this amazing Roth IRA, the tax-free ATM. Think about later on in life and how that matters to you. One last final point I'll make on this is if you think about your estate and whether you need to pay estate tax at the federal level or at your state level, and this is if you have millions of wealth, what type of account do you want to pass on? If you have a traditional IRA that's being passed on at $1 million or a Roth IRA being passed on at $1 million, for estate tax purposes, those are both $1 million assets. It goes into your estate tax calculation. But what happens when your kids inherit that traditional account? They have to pay taxes as the money comes out. That $1 million is maybe $700,000 or $650,000, whatever the tax rate is, because they pay taxes as they start drawing that out. But if they inherited it as a Roth IRA, there's no tax. There's no tax to be due on it from an income tax standpoint because the money's still coming out tax-free. That's another perk here is long-term planning. You're thinking about this where, again, the Roth wins out. Don't make the mistake of thinking about your situation now in your 40s or 50s. Let's think about this in your 60s, 70s, and 80s. What account do you want to have? And making the change now and having some short-term pain on the tax that you need to convert will give you long-term gains overall, better benefits, tax-free wealth, no tax on the money on the way out, better account for your heirs to inherit, and an account that just has greater flexibility and options because you can continue to invest it without having to worry about drawing it down over time. Now, we're big fans of Roth IRAs here at Directed IRA. It's the most popular account that we have at Directed IRA. Many of our customers use it to invest in private assets, whether that's real estate, a private fund, a startup, crypto. These are all assets a Roth IRA can own. So I just want to let you know this isn't just about buying stocks, bonds, and mutual funds in your retirement account. If you really want to be more connected to your money, drive greater returns, have more investment flexibility, many people are attracted to the Roth account because of that tax-free wealth and that growth, and they want to be more involved in the assets that they're investing in, and that's self-directing. So get over to our company, Directed IRA. You can learn more about that, Roth accounts in general, and how you can take control of your retirement. And lastly, please make sure you subscribe to my channel. I'm dedicated to helping you save on taxes, protect your assets, and build wealth. I'm Matt Sorensen. We'll see you next time.